Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/Riiv to receive the top 10 stocks to buy right now. We got a big day of earnings over the last 24 hours, so a lot to go over. We're going to cover the obvious one that I think everybody's talking about today is Tesla. And if you haven't already, please follow me at Riiv Investing here on YouTube, at Travis Hoium on Twitter, and then Jason can be found at The Smattering on both of those, and he has a podcast as well, so listen to that. Let's go over the numbers for Tesla, and you can kind of jump in here. I want to go into like unit economics in just a second, but we can kind of talk about where the trends are heading. Automotive revenue was up 33%. Gross profit was $5.5 billion on a gross margin basis. That was actually down 466 basis points, so almost 5% from 30.6% a year ago to 25.9%. So we're starting to see some margin pressure there. One of the things I was really impressed by is Tesla has, I think, kept its operating costs under control better than like any company that is related to the state of California. And that's giving them the operating leverage that even though gross margins are coming down, they are increasing volumes. So their profits are actually going up slightly, up, I think it's 43% from a year ago to $4.1 billion. Those are kind of the high level numbers. What did you see there, Jason, that you want to comment on?
A couple things that you mentioned there, I just want to kind of circle back around and add some color to, and we'll talk about a little bit more, but I think there's so much focus right now on the price cuts, and we haven't seen those in its reported numbers yet. I think that's the really important thing to remember.
What we have seen is the discounting they did in December. So there was
December, right? But we haven't seen the more recent,
right?
Right. And we certainly haven't seen anything over a full quarter. So I think that's really important context people need to consider when they're looking at the numbers and thinking about the results. But what we are seeing is the impact of price increases from earlier in the year that still provided some economic benefit in the quarter. And the other thing I want to say is that I think broadly Tesla's price cut strategy, whether it's a strategy or just a reaction to demand, is debatable. And I think it's probably a little bit of both. I think it makes sense because this is still at a time when you want to be grabbing market share and grabbing it profitably. And if you can toe the line on those operating costs and find like that sweet spot, then I think it can be a healthy move for the company. But investors need to be realistic that cutting prices is not pricing power. Being able to cut prices while still towing the line on profitability is a cost advantage. And maybe Tesla has that. And this is the big question I have over the long term is how long is it going to maintain a cost advantage as companies that have decades of experience manufacturing cars and have the established relationships with suppliers leverage their with those suppliers and start building their own cost advantages?
Yeah, I think that's right. I'm going to share a little presentation I put together that hopefully puts a little bit of context to exactly what you said, because I think the right way to think about Tesla right now is they are prioritizing volume growth over profitability. That was almost explicitly said in the conference call. And this is what, I mean, this is their unit deliveries. It's on a trailing 12-month basis. And they basically said, I mean, this is the target that they set for themselves: grow volume 50% per year for the foreseeable future. I don't think they put an end date on that.
Yeah, and the key here is that's not 50% every year. It's a 50% CAGR. We are seeing the rate of growth is slowing down.
Yes. So they are planning on getting to 1.7, maybe 1.8 million vehicles in 2023, which is a big number. And now suddenly you're playing in the world of that's about how many vehicles BMW makes.
Right.
So these are really big numbers. I just pulled this is the revenue per vehicle, and I pulled out the credits that they get from other automakers, the renewable energy credits, because that's not really sustainable. That's not part of their pricing. It's not a sustainable revenue source, although it's lasted a lot longer than I thought it would. But I think as these other companies increase their production, that will probably go away over the next couple of years. They did have some price increases that hit in 2022, first half of the year specifically. If you remember, the auto market is still under a really tight supply situation. Tesla has been able to make more vehicles more readily than most automakers. But most companies,
their integrated model actually kind of paid off a little bit.
yeah, and the fact that they're a more advanced company from a technology standpoint. I mean, they're not using the old legacy chips that a lot of the other automakers are. And so that allowed them, if there's no vehicles on any lots, and you can supply vehicles that people can get in a reasonable amount of time, well, you have pricing power. So that pricing power was put into effect in 2022, specifically in the first half of the year. But it has come down. The average sale price. Now, what's a little bit difficult in their numbers is that they do have those high-end vehicles like the Model S and Model X, and then the less expensive vehicles like Model 3 and Model Y. So this is a blended average. And I looked at the numbers and they're ballpark about the same from a mix perspective, but it's not an apples to apples, not necessarily 100% the same vehicle. This is what I think was interesting, though, is the gross profit per vehicle is starting to come down. And that has actually been consistent over the last year. So this is, like you said early on, before the price cuts of up to 20% that happened in January 2023. This does not include any of that. It does include some discounting that happened in December, but that was a much smaller number. So keep this in mind, because Tesla can grow volumes at 50% a year, but if they're making less profit, gross profit per vehicle, that means that their earnings may not go up at all as a result. Anything you wanted to touch on here before I get to the next section?
No, I'm gonna be Charlie Munger here. I have nothing to add.
So here's what has happened over the last few months. Discounting started in early December, $3,750, and then that was increased to $7,500 by the end of the year. Also keep in mind that over that time, over the third and fourth quarter, Tesla added 55,000 vehicles of inventory. So it made 55,000 more vehicles than it sold. The inventory of those vehicles is on the balance sheet.
This hasn't been something Tesla has done a tremendous amount. It's found itself at the end of every quarter scrambling to deliver cars to be able to recognize the revenue, and ending the quarter with surplus inventory. This is how do we analyze it, Travis? There's two ways to look at it, I guess, right?
Yeah. And to get to the inventory number, just to have that number here, $5.7 billion a year ago was their inventory. The end of last quarter, $12.8 billion. Yeah. That's a big, big increase. I have done videos on inventory. I've been writing about companies that get in trouble because they build too much inventory. What you end up having to do is end up having to lower prices. Elon Musk said this during a conference call, because they were talking about the price reduction that they did in January, and they said, we have just a ton of demand. We've had more demand today than we've ever had for our vehicles. And so he said, so basically, price really matters. As somebody who is questioning how profitable this company is going to be in the future, I hear that and I say, yes, because the laws of supply and demand are real. This is the Econ 101 supply and demand chart. This dark blue line is demand. Demand goes down as price goes up. So as Tesla increases their supply, which would be this light blue line, in theory, they would have an equal amount of demand at a lower price. That's what supply and demand would tell us. So if they want to have charge $100,000 for every vehicle, they maybe can only make 50,000 vehicles or 500,000 vehicles per year. If they want to sell 5 million vehicles per year, now you've got to reduce your prices to maybe $30,000 per vehicle.
Thinking about the automotive industry, we're talking about the difference between a Ferrari and a Volkswagen. If you were to look at the two opposite ends of the spectrum, right?
Exactly. So the challenge is that companies always have is trying to find this balance point where you don't have excess supply.
And it's different for every company.
It's different for every company. It's different for every product. Any company that is making a product, especially a physical product, this is the challenge. This is the name of the game. This is why Tim Cook is the CEO of Apple, is because he was brilliant at this. What these two lines here are is the green line is what you can charge in price, and then the red line is your cost. Underneath the green line is your revenue, and between the two, this is your profit. So now, I didn't make 15 charts for this, but you can imagine that if you go down this supply curve and now you have to reduce prices, now suddenly your profit per vehicle starts to go down. In a worst case scenario,
you try to find the sweet spot where you can generate the most dollars of profit per unit of revenue that you generate, right? Because you can increase that gross profit. up to a point by increasing the price of the vehicle, but it's going to reduce the number of people that are going to buy your product, right?
Yeah. So look at
that's
look
the
at
balancing point. That's the tipping point right there.
a Bugatti. Let's say you can make one Bugatti and make $1 million in profit. Maybe you make a Volkswagen and you make $1,000 in profit. But if you make
you can sell a lot more
500 of
Volkswagens
them, you're making less profit.
Bugatti.
Yeah. So it's a balance of figuring out where do you maximize profit. And what I'm arguing here is that Tesla and Netflix did the exact same thing last week, is saying that we are trying to increase our volume over maximizing our profit. And I think that's where
it's cutting margins to increase margin dollars.
Theoretically.
Right.
But this doesn't last forever. And the other thing that's always difficult in a manufacturing business is the fixed costs that go into it. This is not software. You build a plant and then that plant exists. So if you have
all of the costs to keep that
all
plant
the costs
at a minimum
associated
state of operations, they exist.
So if you have 5 million vehicles worth of supply as they build out more and more supply in Texas and other parts of the world, now you have 5 million vehicles of supply. If you start running the aggregation of plants at a 3 million unit run rate, you're going to be less profitable than when you were running full tilt. This is always the hard thing to get your head around when you go from being a growth company and the unit economics just working for you because you're always at full capacity to now we got to balance supply and demand. We got to figure out, well, when do we need to build that next plant? It's not as fast as we possibly can. It's maybe we build it in 3 years.
Right.
And I think that's where we're at with Tesla, is making this transition to now we have to live by the laws of supply and demand. And it turns out we don't have infinite demand at the pricing in Q2 2022. How much demand is there for the pricing in Q1 2023? It appears to be that there's a lot of demand. What happens to margins as a result of that? I think it's already clear they're already going down, and they're going to go down probably pretty significantly in 2023. Tesla continues to ramp, continues to be on that charge to increase production 50% per year. That is a massive increase at their current scale and in the auto business. That was a lot of stuff. You want to kind of recap there, Jason?
Yeah, I have a few kind of closing thoughts on this. Number one is I don't think Tesla's growth days are over, right? Like you said, a year from now, assuming all goes well, right, according to plan, it's going to be about the size of a BMW in terms of volume, right, of vehicles. And BMW is a big manufacturer. They make kind of a middle upscale product for the most part. So I think that's a pretty good comp, but that's not what Tesla's aiming to be. Tesla's aiming to sell Volkswagen numbers, right? So making less expensive cars makes sense, but there's a difference between making less expensive cars and cutting prices, right? I think we should really, really remember that is if you want to make a less expensive car, you have to build a car with fewer features that's a lower cost, not just cutting costs on your more expensive to manufacture products, right? So you have all of those things that kind of come into play. I've said for a long time, and I want to circle back to the Netflix part in a minute, but I've said for a long time, the key with Tesla is how long can it grow at a rate that kind of neutralizes the typical automobile industry cycles that we go through. And this year's going to be a real proving ground for me for Tesla and its ability to outgrow the cycles, because at some point it's going to be at a scale where its growth rates are going to slow and it's going to normalize. And then it's really going to be subject to not just the supply and demand aspects of it, but the cyclical aspects of how that demand can change very quickly. And you have to be nimble and ready to change with that demand, or your highly profitable business at scale, because of those high fixed costs, can be a big money loser. And sitting on 50,000 cars in preparation of the next quarter, and then that demand isn't there, well, guess what? Your fixed costs are higher now because you have to store those cars, you have to maintain them, you have to do all of the things necessary to protect that economic value. And for most automakers, that means you cut the prices to try to move them out as quickly as you can, right? At some point, Tesla's going to be subject to those same things. What we don't know is how quickly that's going to happen and whether or not all of the other things that are part of the Tesla thesis that are baked into its valuation, Travis, self-driving, all of the high margin revenues from autonomous fleets and all of these things, these great ideas that haven't materialized. We don't know if those things are going to be actual revenue generators when this is a mature automaker. And I think that's a real threat to the valuation that investors need to be really thoughtful about.
Yeah, I agree with everything you said. And the other thing that I want to add to this from a demand perspective is I think that we have been in a state for over 10 years now where Teslas were in incredibly high demand.
And there was not a competing product.
There was not a competing product, and it was cool and it was new. There was a price premium. That price premium is slowly but surely evaporating. Go look at the Volkswagen ID4. It's pretty much the same price as an internal combustion engine vehicle. I think that's going to be a really interesting transition for them to make as a lot of these other automakers bring really compelling vehicles onto the market. I've been impressed with everything the Volkswagen has done. I've heard good things about Audi's vehicles. This isn't just $100,000. This isn't just Lucid and Porsche coming into the market. These are really big players that are actually starting to make some numbers. Ford with the Mustang Mach-E. Not everybody wants the same vehicle. I was driving around. We're looking for a new vehicle, and I was talking with my wife about this last night. And what's interesting, you drive around and you can go in and look at a certain vehicle, certain brand, and say, wow, that costs that much money. That makes absolutely no sense to me. But it makes sense to somebody else.
Right.
And Tesla makes 4 vehicles that essentially look the same, and they've looked the same for 10 years.
It's 2 vehicles with 4 badges, I think is the better way to think about it almost.
Yeah. Yeah. So the car buyer going into look for a new vehicle and look for an electric vehicle in 2023, do they look at that Model 3 or that Model S in the same way that the person who was buying the same vehicle in 2017 or 2018 does? I don't think so. There's a reason that automakers refresh their vehicles every 7 or 8 years, because you want to be cool and have the new thing, and people don't want to have
fatigue, brand fatigue. It's
brand fatigue. The Ford Taurus was like an amazing looking vehicle and super cool when it first came out in the mid 90s when they did that brand refresh.
Right.
If you bought that vehicle today, you would look ancient.
Right. It would look as if you bought the Taurus from the 80s.
Yeah. And I think this is the part that we're moving into this more mature phase where Tesla is going to have to live by the supply and demand, like we've talked about, and the whims of the customer. And I don't think Teslas are all over the place now. Even I live in Minnesota. There's a bunch of them within a stone's throw of my house. And I think that's going to be a sort of a drag on them from both a pricing power standpoint and from a demand standpoint, because they're not the only game in town anymore. So we're starting to see, if your thesis is like mine, that this gravy train of high margin sales is going to go on forever, I think we're already starting to see that break.
Look at what's happened to Netflix. I think that's a reasonable comp in terms of a company that was massively disruptive, found a niche where there was gigantic demand, and then just owned it for a decade and was very profitable and made a lot of smart investments to scale up and grow along the way. But now you have all of the other vested interests that you've been disrupting that are now looking at your market, and it's not going to be as easy. It's not going to be as easy.
Yeah, this is going to be a really interesting one to watch in 2023, because I think the trends of the last decade are going to change. I don't know exactly what that means. I think that we can both agree Tesla has a different business model and probably a better business model than the legacy automakers.
No doubt about it. No doubt about it.
It is going to have premium margins for the foreseeable future. I don't think we're going to them reporting a 8% gross margin. They've done a really good job controlling operating costs. They have all these opportunities to add really high margin features like self-driving and things like that. The question is, how profitable is this company going to be in 4 or 5 years? And what do you want to pay for it as an investor? I think that's what's challenging right now. Is we've talked about a few companies within earnings season. There are companies where you go, hey, maybe the future isn't quite as bright as the last 2 or 3 years, but I'm getting a really good price.
Right.
This is one where I go, maybe the future isn't quite as bright, and I'm also paying a really, really high price. And that's where it sort of breaks my brain. Anything you want to add
I'm
before
with you
we?
there. I love the business. I really do. What the company has done is incredible for the world. You know, it's making the world will be better for my 6-year-old son in 20 years for what Tesla has done. I don't want to own the business because I think there's so much risk about everything you were talking about what can it possibly be versus what is it actually going to be, and the price you're paying for that future that's already baked into today's share price.
You can love the company, you can love what Elon Musk is doing, and not love the stock.